Our analysis last time focused on the highly specialized structure of Cadra Holdings. Today, well, we're tackling almost the polar opposite, National Presto Industries. It's a really fascinating company, partly because it operates across such, well, divergent sectors. You've got housewares and small appliances, then high-demand defense ordnance, and safety segments too. So the core question we need to wrestle with is this. Does National Presto Industries' current valuation, sitting around, $114 per share, does it adequately account for the inherent risks, especially its heavy reliance on the defense segment and those noted corporate governance deficiencies? Or, alternatively, do the recent performance metrics and its, frankly, extraordinarily strong balance sheet justify that market price?
Well, I'm going to argue that the significant structural, operational, and governance risks we see demand a substantial discount. When you actually look beneath the surface of their recent sales growth, you find these conflicting intrinsic value signals and, frankly, systemic governance weaknesses. The current price seems to be pricing in perfection for a company that is, I think, fundamentally structured for uncertainty.
And I'll take the other side. I'll argue that focusing purely on those structural risks, well, it ignores the tangible benefits of their actual execution. National Presto Industries demonstrates such robust recent performance and maintains such a safe, almost fortress-like balance sheet, that these factors not only offset the complexity you're citing, but they actively justify and maybe even suggest some upside from the current market price.
Okay. Let's dig into that robust performance then, starting with the metrics you're leaning on.
The market is clearly responding to strong results. Over the last year, the stock has climbed over 53%. And in the last quarter alone, we saw an 18% gain. This momentum, it's supported by really incredible growth rates. Trailing 12 months, TTM sales growth is sitting at an impressive 31.27%. And TTM earnings per share growth is right behind it at 26.36%. I mean, these are high growth numbers, right? Often associated with much smaller, maybe riskier companies, not a century-old industrial player. Liquidity is very high, defined by a current ratio of 4.21. So that means they have over $4 in current assets for every dollar of current liabilities. It's substantial. And their leverage? It's virtually non-existent. Debt to equity is sitting at 0.06, with long-term debt to equity at just 0.02. Barely there. And, if we run a valuation model that prioritizes reliable income streams, something like the dividend discount model, it actually suggests a fair value estimate around $122. So that safety margin, it supports the higher valuation.
While your dividend discount model, which, focuses on the stability of their payout history, hits $122, the discounted cash flow, or DCF model, estimates the value almost 30% lower. It comes in around $181.30. And even the GF value metric puts it lower still, somewhere around $76.02. I mean, this massive spread from $76 all the way up to $122, that's like a 5-alarm warning for investors, isn't it? It reflects the extreme difficulty analysts have in modeling future cash flows for a conglomerate that's linking, consumer goods with volatile defense contracts. When your methodology yields such wildly divergent results, the market price of $114 is likely priced based on, the most optimistic scenario.
The disparity reflects the difficulty in modeling a complex entity. Yes, absolutely. But perhaps it's primarily because the DCF models are being maybe overly punitive regarding the terminal growth rate of that defense segment. Or maybe it's just a difficulty in predicting long-term reinvestment given that massive cash hoard they have.
Well, it gets far worse, I think, when we consider the managerial structure that's actually overseeing this cash hoard. Look at Institutional Shareholder Services, ISS. They assign National Presto a high-risk governance score, a 7 out of 10. They flagged concerns in board structure, audit practices, and, critically, executive compensation. Specifically, the compensation program lacks objective performance metrics, and it almost entirely omits long-term stock-based incentives, LTIs.
Okay, before we dive deeper into governance specifically, we really have to address the primary driver of the stock's recent success, which is the defense segment. I'd argue that this focus supplying ammunition and ordnance primarily to the U.S. government isn't merely a risk factor. It's actually a foundational strategic advantage right now.
But that reliance is precisely the source of the volatility we're seeing.
Hold on, let me finish. It's the engine that drove that 31.27% TTM sales growth we talked about. It positions National Presto as a reliable defense stock at a time when, well, geopolitical stability is paramount. So this reliance currently is a strength, and we saw evidence of this in positive earnings reports like Q1 earnings rising year over year, specifically because of higher defense sales. I mean, this is a blue chip customer, the U.S. government, providing a massive, potentially sticky revenue stream.
But the source material itself seems to contradict the idea that this is some kind of stable, foundational advantage. It explicitly cites execution uncertainty on the large defense backlog. You know, converting that backlog into reliable profit, well, it's not guaranteed. Any defense contractor faces massive supply chain and execution risk. And we saw that instability almost immediately when, in a subsequent quarter, Q2 earnings were actually down year over year. And this was despite sales being up a massive 42%.
Okay, but a 42% sales increase is still impressive, regardless of a temporary dip in earnings quarter over quarter.
But doesn't that suggest significant underlying execution difficulties or cost pressures? Tariffs and production costs were mentioned as issues. My real concern here is that the high sensitivity to geopolitical factors means performance can rapidly reverse, completely outside of normal consumer cycles. This conglomerate structure is supposed to offer some kind of hedge, right? The, stable housewares business balancing the volatile defense side. But if the defense side introduces such drastic swings and the houseware side, like with the pressure cooker and percolator segments, introduces high, non-recurrent litigation risk, well, where is the operational stability coming from?
Look, sales overall are undeniably strong, and National Presto does have a long history of successfully converting defense contracts. Yes, execution risk is inherent for any defense contractor, I concede that, but that exceptional financial safety net we discussed, that minimal debt-equity ratio, it positions the company exceptionally well to absorb short-term fluctuations without really endangering its capital structure. They have the financial strength, the cushion, to weather these kinds of storms.
Managing solvency is one thing, optimizing capital is entirely another. And this forces us right back to the valuation conflict. How can we, as, sophisticated investors, really rely on that $122 DDM value when a detailed DCF analysis is sitting nearly 30% lower at $81.30? The DCF model is likely, and I think correctly, punishing the lack of clear long-term growth vectors for the Housewares division, and it's discounting the uncertainty in that defense backlog conversion. Whereas the DDM, well, it simply reflects a history of sustainable dividends, which might not reflect future risk.
But that DDM reflects a history of shareholder loyalty, of income stability that should be rewarded in the valuation. Moreover, a PE ratio of 19.55, based on that $5.84 TTM EPS, that's certainly reasonable, especially when you pair it with TTM EPS growth exceeding 26%. I mean, growth like that often justifies a multiple far higher than 1955, doesn't it?
Yes, but we have to look at the sustainability of that growth, especially in light of their payout policy. That PE is arguably constrained by a really aggressive payout ratio of 77.37%. That means a substantial amount of their earnings per share is immediately tied up in just sustaining the $1 TTM dividend, not necessarily going into crucial reinvestment or capital expenditures or even just building a larger buffer. The margins for error there seem quite tight.
Those extreme financial safety measures, like the 4.21 current ratio and the minimal debt, they suggest significant operational optionality and resilience. This is a massive buffer. They have tremendous dry powder, for potential acquisitions in either segment, or maybe for increased share buybacks, which often supports higher intrinsic value estimates by de-risking the overall business model. They seem financially prepared for, well, almost anything.
Exceptional liquidity, like a 4.21 current ratio, when it's combined with relatively low operational efficiency metrics, look at the operating margin, 11.19%, or return on assets, ROA, at 9.34%.
that can actually be a signal of inefficient capital allocation rather than just simple strength. Why is all that capital just sitting there, relatively idle, when it could potentially be optimized?
So you're suggesting that this financial strength is actually evidence of mismanagement?
Precisely. Or at least suboptimal management driven by poor incentives. This potential inefficiency is particularly concerning given the lack of long-term incentives for management to actually optimize shareholder returns, which loops us right back to governance and capital allocation, the high-risk ISS governance score, and the explicit lack of stock-based long-term incentives. These look like key structural flaws to me.
While governance scoring is, yes, academically important, the market ultimately votes based on results, right? And the company has delivered significant long-term performance despite those institutional flags. Performance over 3 years is over 86%, and over 5 years, it's over 66%. If the management structure were fundamentally flawed in a way that truly hurt value, will we really see those kinds of returns?
But past performance doesn't negate future structural risks. The lack of LTI means executive interests aren't necessarily aligned with long-term shareholder value creation. It makes that 4.21 current ratio look maybe more like hoarding cash rather than strategic optionality. And this could inhibit their ability to attract the top-tier senior talent required to manage such a complex multi-segment business effectively in the future. Poor governance, I maintain, is an undeniable discount factor that sort of poisons the well for future sustained value, regardless of how well the last defense contract panned out.
But let's look at the stabilizing factors within that management structure. You have high insider ownership, sitting at 26.22%. That suggests a significant vested interest and management stability that might compensate, at least partially, for the formal weaknesses in the LTI structure. The focus, I believe, should remain on the undeniable, tangible results, income of $41.58 million, sales of $450.60 million, rather than focusing solely on institutional risk flags that, historically, haven't prevented strong equity performance.
But the litigation exposure links directly back to operational oversight and management priorities, doesn't it? I mean, this company faces multiple product liability lawsuits related to pressure cooker burns. There's a 2024 class action over alleged coffee percolator capacity misrepresentation. And they even had a past SEC lawsuit for failing to register as an investment company years ago. This history, it suggests perhaps a recurring pattern. A failure in internal controls and oversight that seems directly related to those governance deficiencies, and that adds measurable legal and operational risk right into the valuation equation.
Okay, that's an excellent point that really encapsulates the core of our disagreement here. Whether the proven financial safety and the recent strong performance outweigh these quantifiable operational and structural risks you've highlighted. So in summarizing my position, National Presto Industries presents a compelling investment case. It's driven by powerful momentum, particularly in its defense segment right now. And this performance is uniquely underwritten by, as I said, a fortress-like balance sheet, minimal leverage, immense liquidity. Yes, the valuation models conflict, largely due to the company's complexity, but the empirical performance and these safety metrics, I believe, argue strongly against applying a deep discount to the current stock price.
And I'll maintain that the company's inherent operational complexity, simultaneously managing military ordnance contracts and defending Housewares litigation, that, coupled with its apparent failure to align executive compensation properly with long-term shareholder returns, presents substantial, measurable risks. Investors really must carefully weigh the strong, perhaps near-term upside from the defense contracts against the very real discount factors embedded in those governance issues, and, crucially, that wide, frankly unnerving dispersion of intrinsic value estimates.